Hey guys and gals, Kevin Bupp here. I've got some very exciting news I'd like to share with you before we jump into today's show. Now, after closing on Fund 4's first acquisition of a $50 million institutional grade mobile home park, we're adding a second irreplaceable piece of real estate to the portfolio, and it's coming into the fund with over $1.5 million of built in equity for our investors day one. Now, when I say irreplaceable, I really do mean it. I mean, this is an affordable yet high-end waterfront mobile home park located in the Columbus, Ohio market. Quite literally, every single mobile home on this property is right on the lake, each with its very own personal boat dock, meaning a very high demand for affordable weekend getaway options, as well as year-round housing for working Americans. This is a true unicorn of a property, and you will not see another one like this come around again. It really is a one of a kind. A few other aspects worth noting. This park is producing stable and predictable cash flow day one. We're acquiring it with an excellent in-place Freddie Mac loan at a 3.3% interest rate for the next 8.5 years. This also includes a period of interest-only payments. Again, the simple supply and demand dynamics here are enough to get excited about. This is affordable lakefront real estate for both the working American families as well as folks looking to lock down a reasonably priced waterfront escape. Don't let this opportunity pass you by. Visit investwithsunrise.com to register for our webinar and learn about all the wonderful aspects of this property going into Fund 4. Again, that's investwithsunrise.com. Now, let's get on to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert Mark Khuri. Now, Mark has been an avid real estate investor for over 18 years, and throughout his career has invested in over 45 commercial real estate opportunities across numerous asset classes, some of which include mobile home parks, self-storage facilities, multifamily communities, retail shopping, oil wells, student housing, vacant land, short-term debt, and ATMs, all of this representing more than $1.5 billion of combined value. And so with that, it's an honor to welcome back Mark Khuri to the show. Mark, how you doing, my friend?
Kevin, doing well. Thanks for having me.
Yeah, excited to have you back. Always good to see your smiling face and more importantly, to talk shop. I mean, it's interesting. I didn't even look back to see last time I had you on the show. It's been definitely a few years. I can't remember if it was pre-COVID, during COVID, but either way, now like all those last like 4 years have kind of blended together. Lots has changed in the real estate space. So just really excited to get you back on here and just more so just, catch up with you and see what's new and great in your life. But with that, just for those that I guess aren't familiar with you and your story, don't know anything about you, Mark, maybe take a few minutes and maybe fill in some of the blanks of my introduction about a little bit who you are and what it is you do. And, I guess more importantly, also how you found your way into the space.
Yeah, happy to do so, Kevin. I won't spend too much time on the history, but I'll just let you know kind of what got us to where we are, which is always a fun story, which you never expect to actually end up where you think you're going to go, right? And so I was in corporate America for many years, working as a financial analyst, budgets and planning, internal auditing, a lot of spreadsheets. And while doing that, started investing in real estate on the side, as a lot of people do, very active investing, buying fixer-uppers at the courthouse steps, partnering with family members to continue to do that. We built, just my family and I, a small portfolio. This is during the recession, 2006 to 2009, give or take. We were buying properties in a few different states while working full-time. 2010, decided to leave corporate America, went full-time in real estate investing, partnered with my father, started our company, SMK Capital Management, and really just expanding on what we were doing as a family. We started raising capital from some colleagues and some friends that had already, of course, knew and trusted us, and did that for, another 5 years as an operating partner and sponsor in single family, small multifamily, heavier value add, typically 12 units or less was our specialty, Kevin. Mm-hmm. But at the same time, I left corporate America. I had a 401k sitting idle now that I was self-employed. And I started looking around, trying to figure out in, 2010, where should I invest some of my personal capital and still get a great return while being very cognizant of the market at the time, which was upside down, to say the least. And so stumbled on mobile home parks and some self-storage, some apartments, and just started investing as an LP, myself and some family members, in other operator and sponsor deals. And did that for about 5 years in unison of actually doing our own deals the whole time. And by the end of that kind of phase, I would say we had a bunch of data that we could compare and contrast on different asset classes, different operating partners and sponsors. We could compare risk versus return, and what we were also doing, of course, in our own deals. And by 2017, just decided that we're going to pivot more into, kind of what we do today, private equity, real estate investing, where
Hmm.
we raise capital from our investor network, Kevin, and we partner with other sponsors and operators in different asset classes, different locations, strategies, you name it. Really focusing on diversification. It's a big part of what we think about every day. We create multi-asset funds. We also do single asset opportunities. And really, that's what we continue to work on day in and day out, every day here.
Yeah, I appreciate that, Mark. And so, random question, but just curious as to what the answer might be. And I know it's going to be a tough one to answer, but just given all the changes that we've seen over the last couple of years, right? And you've invested in quite a wide, diversified range of asset types. And I know it's a loaded question, but if you had to pick one today, as it sits on April 16th, like based on all the factors and all the variables, like what would be the one that shines and stands above the rest? Again, self storage, mobile home parks, multifamily, ATMs, oil,
Sure.
oil fields, all that, right? Again, no, I know it's a loaded question, and I won't
No, it's
entirely
all
hold you to
good.
it, but I figured it would be very fitting for the times.
I'll say this unbiasedly, knowing what you do, of course, it's the same answer though. It's mobile home parks.
Oh, I wasn't guiding you towards that answer. Hopefully that is a genuine answer from you. I wasn't trying to
Oh,
guide you in that direction.
it really is. It really is. It has been for a number of years. I mean, we continue to see a lot of data to support that. As far as supply and demand disequilibrium, rents continue to go up even when other classes are struggling. And then you just have this, what we've been saying for many years, Kevin, and you know this, just a long-term trend of housing affordability crisis in the US. And so there's so much data that we can point to that continue to show us that, but we also see it in our investments as well.
Yeah, yeah, that's a great answer. Again, I was not trying to guide you towards that in any means. So, but
Sure.
I appreciate the honest response. It's interesting because I feel like I've had this conversation more often than not over the last couple of months now, as there's just a lot of volatility in other asset classes. But the unique thing about mobile home parks, we're both very familiar with multifamily. Both have invested our own capital into it, have raised capital for it, and so traditional multifamily that is. But I like to say that like mobile home parks, number one, like they've evolved. I mean, it sounds like you started buying them back in 2010, right? And so like I know that's not that long ago, but it kind of is as far as like the evolution of a mobile home park and just even the quality of the new product that's being made, that's being built, right? Like it's just a night and day difference from what it was 13 or 14 years ago. Like I mean, there's some really nice mobile homes that roll all these factories that are literally built pretty darn close to the same standards of what you might expect from a site built home. And again, all come in all different grades as far as quality, from builder grade all the way up to like the luxury mobile homes. But with all that being said, I like to always make the comparison of like you could take any one of our parks in any market. I don't care. You can pick any market that we currently own in, and take any one of our 2.5, 3-star parks, which, you know, I would argue that they're probably more akin to that of like a B minus or a B class apartment facility if you wanted to do apples to apples. But even if let's give a traditional multifamily benefit of the doubt, I would say that comparing that same 2.5 or 3-star to like what would be a C class, right? Like a C plus class community, which is I think what most people envision would be a similar demographic of what would be looking for a mobile home, would also consider a C class apartment complex. But I guarantee that anywhere we own anything, that 3-bedroom 2-bath mobile home is going to be substantially cheaper, assuming like it's a rental. We have a rental in the community. It's going to be substantially cheaper, probably to the tune of 20, maybe 25% in some cases, maybe even more than that in some instances, than the comparable like C class apartment community, which that's just, and in that demographic that we're serving, as far as, trying to make our dent in the affordable housing crisis, like that 25 or 30%, or even if it's 20%, it's a substantial amount of money, right? Like that's literally the equivalent of like of a car payment on a monthly basis. And so anyway, I just think it truly is like it truly is the best form of affordable housing. And unfortunately, getting municipalities on that train, getting people on board of like, hey, this is probably a really good solution, and we should all really take a deeper look at it, because we all complain and cry that we've got a affordable housing crisis, and we've got a really good solution here that, that paired with, new multifamily being built, and other types of affordable housing. I mean, like, now we start to make a dent in this big crisis that we have. But I don't think we're still not there yet with mobile home parks. They're still not truly, being acknowledged as a real solution. Although all of us that are in the space, that invest in the space, we understand that it truly is. Like it really is, probably the best option as far as, curbing this affordable housing crisis. So anyway, just went off on a little bit of a tangent there, but just I would love your thoughts and feedback on that. Of like, that's the argument I make about the affordability. And the only thing you can really, the best comparison is like two multifamily. Like that's, people understand that. And I think it's a
Sure.
good apples to apples comparison. But just curious if you see the same thing, or if you feel the same way as far as like bang for your buck, when you're looking for
Yeah.
affordable housing.
Yeah, I would agree with just about everything, Kevin. I mean, you mentioned some really important points. It is typically the most affordable housing solution in the country.
Mhm.
The problem we face is that the amount of income that the cities earn from taxes on a mobile home park is significantly less than typical multifamily, right? And so,
Yep.
there's a rub there. It doesn't necessarily work for the city. And so that's where you get that NIMBYism. That's where you get
Yep.
really difficult supply constraint situation where we can't build new. And if you do, they're usually far off in a rural area, or they're really not affordable because they're so expensive from a land
That's right.
and
That's
so it's
right.
hard to create supply, which you and I both love, of course, as investors in the space. And I'll tell you what, it's only gotten worse, unfortunately, for residents, right? I mean, we looked at some data. I mean, gosh, I'll give you a stat, right? The percent of households that could afford a home, it was roughly around 45 to 50% of Americans could afford to purchase a home between 2010 and 2020. So from that decade, it averaged around 45 to 50%. It dropped in half to 25% in
Wow.
2022. That was before interest rates went up significantly. And so it's only gotten worse. And we just have this exacerbated problem in the US of, significant housing shortage, especially affordable housing across the country. And that's in every single market.
Wow. Yeah, that's great. Any idea what the most recent stat is now with these interest rate hikes? I mean, obviously, it's less than 20. Was it 22% or 25%? What was
It was
the?
around 25%
Yeah,
as of 2022 of
it's
folks that could
it's got to be
afford a
below
home.
20% now. I would guess, which
I,
is
I would think so too. Yeah, I mean,
unfathomable.
even at 25%, I mean, that is a very low number. So
Yeah, no, I agree. I agree. So, just it's interesting just talking about the change that's really played out since the rate increase started, just a few years ago, and kind of where we're at today. Looking back, the general sentiment, I think, of elite, well, I guess, from the Fed's perspective, as of last year, was that we would have, a number of rate cuts this year. I think maybe they said like maybe it was two or three or four, I can't recall. And then, but the market felt as though like we would see maybe up to six rate cuts in 2024. But as of today, as we record this, it looks as though Powell has pretty much dialed back expectations to one to two, maybe two rate cuts this calendar year. And we know a lot of things we don't like to see a lot of shakeups during election years either. And so anyway, just curious as to kind of what your thoughts are, and more, I guess more specifically, are there any changes that you guys are making in your business to adapt to maybe some of the uncertainty or potential volatility that this creates, meaning that we're going to stay in a higher interest rate environment for longer?
yeah, I mean, gosh, there's a lot I could speak about. What's going to happen? Who knows, Kevin? Right?
Yeah.
I don't try and speculate as to how many rate cuts there may be or when. We tend to look at that as downside protection. We're not necessarily underwriting anything to show rate
Mm-hmm.
cuts, that's for sure. And then obviously cap rate expansion, right? We've already experienced a lot of that. Most of our deals in the last 5 years, we've underwritten pretty significant cap rate expansion, thankfully, because that's essentially transpired almost in every asset class to date. We've seen anywhere from 50 to 200 basis points of cap rate expansion, depending on vintage, location, and asset
Mm-hmm.
class. And then, so what we have done is we continue to be very prudent and diligent and patient on what we're going to choose to invest in. So we look at 10 to 20 different investment opportunities every month. We invest in 5 to 7 a year. So roughly 97, 98% of the deals that we see, we don't invest in for a number of reasons.
Mm-hmm.
A lot of times we see today negative cash flow, negative leverage. The amount of income that the properties produce isn't sustainable for the amount of the debt cost. And so you're losing money every month. Operating partner sponsors can overraise in the beginning to help pay those expenses for the first couple of years until you get the business plan up and running and start producing positive cash flow. But that's just not a type of investment that we want to get involved in. So most everything we're doing today, Kevin, we look for positive cash flow year one, net to our investors 3 to 7%. And then
Mm-hmm.
we want that to be increasing. Average cash flow while we hold is 7 to 12%. And then when we add in profits from the sale, the total return to our investors usually projecting around 15% plus average annual ROI.
And
We
that's
do
based on
that.
a 5-year hold.
5-year hold, typically 1.7 to 2.5 equity multiple. That's where most
Mm-hmm.
of our deals land. But it's in the niches, right? And so you're not finding this stuff every day out there. Most deals we see don't hit those numbers, don't meet those metrics. We're looking for opportunities where there's a very healthy spread between the interest rate, the borrowing cost, and the going in cap rate. We want to see anywhere from 100 to 200 basis points of delta there. It just helps produce margin and cash flow day one on an investment, because who knows what's going to happen, right? There's a lot of turmoil in the marketplace, geopolitical issues across the world. There's a lot of instability. And so we're just trying to position ourselves where as soon as we close on an asset and make an investment, we're okay if a lot of things change, right? So it's just downside protection, and we're focused on not trying to hit home runs, perfectly happy with singles, doubles, and maybe some triples. But that's really where we're playing today.
I'm assuming at this point in time you're not seeing any spreads, in the multifamily space. It's probably all negative for the most part. If you're looking at spread between current rates, going in rates to going in cap rates on any deals, right? Like you're not finding quality multifamily assets that you could pick up at 7 or 8 caps, right? That's just not the playing field today.
So there is a niche within multifamily that we've been investing in for the past couple of years that does provide that healthy space. It's
Hmm.
tax exempt apartments. Are you familiar with those?
I am. I
Yeah,
am. Hmm.
that's where we're really, I mean, almost all of the apartment deals we've done in the past 2 years, Kevin, have been tax exempt.
Got it.
So you do get 150 basis point spread typically on those acquisitions. You also usually can invest in Texas and growth markets, and have a very nice cash flow year one, and most of it's newer vintage. I mean, we've done 2022 build apartment in Dallas that's
Hmm.
cash flowing 6%. These kinds of things. They're rare. They're hard to find. Don't get me wrong, but you're right. Most other non-tax exempt apartment deals are looking at negative cash flow year one.
No, no, I'm very familiar with that space, and I love that niche. It's a very unique niche, and very, very much a specialized niche at that. So,
Yeah.
no, I agree with that. So, as far as just again, curious your sentiment on, one of the kind of the general theme. I think I mentioned to you that I was at the Best Ever Conference. The very first day, it was really geared towards limited partners, and the general theme was that a lot of folks are kind of upset. anytime a deal doesn't go as planned, right? Like we surely can't control what played out over the last couple of years with the rent increases, and and I don't think anyone no one saw rates going up that fast, that high, over that short span of time, and and some are handling it better than others. I'll leave it at that, right? But ultimately, you had a lot of LPs that were just less than satisfied with it seemed more so related to like just communication from from the sponsors, just the good, the bad, the ugly, right? Like it's easy to give good news, it's difficult to give hard news. But but I guess where I'm going with this is not necessarily what have you guys I guess how do you communicate with your investors? What kind of sets you guys apart as far as maybe I will ask. Let's go that. Let's go there for a second. Like, is there anything unique that that kind of sets you guys apart as far as just general communication with your LP base, your investor base? Is it just normal quarterly reports? You guys go above and beyond? Because it seemed as though the feedback I got was like a few people kind of stuck out that kind of gave examples of what they do and how they communicate, stuck out above just the rest of the masses there. So just curious if what it is you guys do and what have you found to be the sweet spot as far as ongoing communication with the investors.
Sure. Yeah, it's first of all, it's critical, right? Being a good communicator is one of the most important things in this business.
Mhm.
That's not just to our investors, but also back and forth between our operating partners and sponsors. And so we expect it from those we work with, and then we also, provide it to our investors. And so it works both ways. What does it mean to us? I mean, I'll give you an example. We do quarterly updates and distributions for all of our investments. In
Mhm.
between quarterly updates, all of my investors have my cell phone number. And so
Mhm.
it can schedule a call and we can talk about anything they want. And if they have 100 questions, we'll answer 100 questions. It's just the way it goes. You can't ask too many questions is really how I feel. Part of my, I guess, background is, as a financial analyst, I ask a lot of questions and there's a lot of diligence I do. So
Yep.
I understand when people go into that mode and appreciate it. And it just takes time. We got to spend a lot of time responding to questions. And so whether that's in person on a phone call, a Zoom chat, or in an email, all of the above we do regularly. Now for our kind of our more routine quarterly updates, Kevin, we spend a good amount of time putting together all what we feel to be material and relevant updates in those communications, right? And
Mhm.
so if if we walk away from that distribution email and update feeling like we've answered everyone's questions, we'll know pretty soon. Because if we didn't, they're going to start asking our investors will ask questions.
That's right.
But almost all the time, we don't get a lot of response and questions from our folks because I think we've done a pretty darn good job of being transparent, forthcoming, and detailed in that communication. And so, I mean, when we run a multi-asset fund, some of those quarterly updates are 15, 20 pages long, with text and updates. And so it takes time. Investors do need to read them, of course, but yeah, you got to be detailed and thorough and transparent. It's just something that we've always paid a lot of attention to.
Yeah, no, that's great. I appreciate that. And I guess one other thing would love to get kind of your perspective on, especially again given the just the change in the times. I feel like rising tides lift all boats. We all can agree there. And so like it was very hard to lose money or not make money, however you want to look at it, up until a couple of years ago. I mean, you could seemingly put your money and you're behind any jockey, any sponsor, and you'd probably, it would exceed expectations, right? That were laid out. It would exceed pro formas. And so, however, the times have changed dramatically. And so maybe it's some advice, if you would, you mentioned you ask a lot of questions just by, analyst by trade, you ask a lot of questions. You just inherently take deep dives into due diligence and whatever decision that you're going to make, whether it's an investment decision or any of the above. And so any advice that you might give, those that are out there that they're looking for potential passive investments today, and really, again, folks need to buckle down and really take a true deep dive. If they think they said they were taking deep dives before, they need to go like 20 feet deeper, 30 feet deeper, as far as what sponsor they're going to put their capital with. And so, any advice you might give there, as far as just how do we do? What are they looking for today? Because it's kind of messy out there, right? Like it's
Sure.
sometimes it's kind of hard to really work their way through all the noise. There's just a
Yeah.
lot going on, lots of changes that have occurred over the last 2 years. So just any advice you might have would be great.
Yeah, I mean, gosh, a culmination of things come to mind, Kevin, that I could share with you. I'll say that it's not a one size fits all, right? We know what we like to invest in. We know the kinds of returns we're trying to seek. We like
Hmm.
income and growth. We like cash flow. We look for conservative leverage. We look for sponsors and operators typically have over 500 million in assets under management, some of them over a billion. We look for if they can get localized knowledge of a specific submarket where you're investing into. Maybe they own 3,000 other units or doors
Hmm.
within 5 miles of the one you're investing in. If that's the case, then you have a pretty unique situation. Doesn't mean everything's okay, but it helps reduce risk of the
Sure.
assumptions that they're making in the pro forma. And so we're trying to always find something unique. What makes this deal better, superior, lower risk than the other 10 that we saw in the past week and a half? Usually there's a story. Why is the seller selling? What have they done wrong? Is there some human error that we can correct and take advantage of, right? That's the business we're in. And not relying on, natural market appreciation. We want to
Hmm.
force value. And so how are we going to do that, right? Think about that question. And of your operating partners, how many times have they done this before? Show us your, portfolio of current holdings, actuals versus projections, right? And that's
Hmm.
something that right away can paint a picture. And don't expect perfection, because if you do, you're not going
Sure.
to invest in anything, right? But at the same time, do your homework to see if this is the right group that can really give you conviction that they're going to be able to execute on the business plan and meet or beat the projected returns, right? Another
Hmm.
question, if you don't know too much about analysis, that's fine, right? Ask. If you can't dig into the pro forma and look at all the underwriting, just ask them, where are you being conservative in your projections?
Yeah.
And wait and see what they say. I mean, are there certain value add options that they're not even including in the pro forma that are just gravy on top? Well, great.
Hmm.
Let's look at that, right? Versus everything having to go correct in order just to hit the projected return. And so, that kind of conservative thought process is something that we look at every day, and we're looking for sponsors and operators. A lot of them that we work with, think the same way. They're always trying to outperform, right? That's the goal.
Yeah. No, it's great. I appreciate that. And so I guess last question here as we kind of round this out, just what does the remainder of 2024 rub that crystal ball? Tell me what the remainder of it looks like for you guys, for you and your group, right? Not necessarily what's going to happen in the marketplace, this, that, and the other, but just what are you most excited about, for the remainder of this year?
Yeah, I don't know yet, Kevin. That's a great question.
That's a good
This is
answer.
one of those years, yeah,
That's probably
where
how I would answer that. I don't know yet. I mean, we got a lot of good things working, but yeah, just I feel like it's too early to really
it's a little
paint the full
early, right?
picture.
We're in middle of April of 24.
Yeah.
So I'll say this: we haven't brought a standalone single investment to our investor group in 7 or 8 months.
Hmm.
We just haven't found one deal that we would invest in solely on its own that really checks all of our boxes. We create funds, and so we've invested in through our fund. We're closing our fund shortly here, and we'll probably open up another one in the coming months. So that's exciting. But at the same time, there's all eyes on deck. We don't know what's going to happen this year, Kevin. I think the worst is behind us from a macro and kind of asset adjustment and value standpoint. We've seen, proper, like I mentioned, cap rates have gone up, and we've seen valuations anywhere from, call it, 15 to 30% go down, right, in the last
Hmm.
year and a half since the peak. And so, and there's a lot of big groups out there, Blackstone's coming out and saying that the bottom's already passed, and now's the time to get in and invest heavily into real estate. And maybe they're saying that because they want to start spurring some transactions and activity, but there's a lot of data that shows they're not
Yeah.
wrong either. And so
Sure.
I think I'm hopeful. Again, you said it's election year. It's I think the last 9 election years, GDP has been positive.
Hmm.
And so historically, we see that during election year, go figure, the economy tends to do pretty darn well. We'll see where it goes. I'm optimistic by nature. I also think it's time to be cautious and see if we can find deals that are almost no-brainers, right? You look at it and say, I want to invest in this tomorrow. Like, let's go do this now. And so those don't come around very often, but when they do, that's also what I'm very excited about. We're gonna push.
Yeah, yeah, no, fantastic. Well, Mark, always fun catching up with you, and I appreciate you coming on and just just giving the lay of the land and what it looks like for you guys. And yeah, it's been too long. We need to do this more often, but again, appreciate your time. And for those that want to learn more about you and your group and just stay abreast of new opportunities that you guys are bringing to market, where's the best place to find you?
Yeah, I mean, our website is a great spot to start, Kevin. That's smkcap.com. And then you can always email me as well at info@smkcap.com. Happy to set up a call and see if what we're doing may be of interest to folks.
All righty. Good deal. Well, Mark, again, always appreciate having on, my friend, and you take care, and best wishes to 2024 and many years beyond that. You guys hopefully have great success and start finding many more of those opportunities coming your way that check all the boxes. So again, my friend, always fun having you,
Likewise.
and we'll catch up later. Okay.
Thank you, Kevin.
All right. Take care. Bye bye.